JOST Werke SE is a global leader in safety-critical systems for the commercial vehicle industry, known for innovation, reliability, and strong customer partnerships. With its worldwide footprint and focus on efficiency and sustainability, JOST continues to drive profitable growth. Today, Romy Acosta, Head of Investor Relations, presents the 9-month 2025 financial results, highlighting key performance metrics, market trends, and the strategic initiatives shaping JOST's future. Romy, the stage is yours.
Thank you for the introduction. So let's talk about the third quarter of 2025 for JOST. We managed to accelerate our growth across all regions, not only through our M&As effects from the acquisition of Hyva, but also through market share gains and organic growth. And that despite the market environment being quite challenging and not supportive at all. But we'll get into that in a moment. Our Hyva post-merger integration process is fully on track, and we've seen the first ramp-up of synergies advancing further with new cross-selling opportunities that we've identified and started to realize, and that too have contributed to the growth that we managed to achieve in the quarter. In general, we had market share gains in all regions and in all business lines, successfully combining our local-for-local approach with the global strength for JOST, which allowed us to reach new customers and continue to improve compared to prior year and also compared to the prior quarter. The market demand in Europe strengthened further, following a trend that we started to see in the second quarter of this year, while the US markets continued to contract, led by the uncertainties concerning the tariffs, especially in transport, but also in agriculture and construction. We thought the markets not being as supportive as before. Despite this, and given the results that we achieved in the quarter, we are confirming our outlook for the year 2025. And now let's talk about the numbers so that you see how we fared in these circumstances. So as you see here, we reached a growth of 55.6% compared to the prior quarter. That, of course, was strongly influenced by 121 million M&A contribution for the Hyva acquisition that we consolidated in February of this year. But despite the very sharply shrinking demand in the US markets and the overall uncertainties in the industry, we managed to grow also organically by 9.7%, as a roughly 10% in Q3 compared to prior year. Here, the biggest contribution was, of course, the agricultural business, which is starting to recover, especially on the dealer channels. There we saw an increase in demand in all regions, and also in transport, which is the market that has been more affected, especially trucks and trailers, by the US decline. We still managed to achieve a growth of 3% reported, and organically, as adjusted for fixed effects, that growth could have been 6% in the quarter compared to the prior year. Fixed headwinds, of course, I think a lot of companies are affected by that. This quarter were 3.1 percentage points in general, but overall, very good development of top line. Also on the earnings profitability of the business, we achieved a quite good result, reaching in the third quarter 9.7% adjusted EBIT margin. At constant currency, it could have been 9.9%. And here we see, of course, the decline compared to prior year in the margin is mostly due to the integration of the Hyva group, which had a dilutive effect as we announced, but we are seeing already the first synergies helping to boost the profitability in the group. And thus we managed to achieve actually quarter on quarter an increase in the margin from 9.5 in the second quarter to 9.7 in the third quarter, and the adjusted EBIT grew by 40% to 37 million euros, one of the highest adjusted EBITs that we've done, achieved in a single quarter. This was supported by our strategy, a wide mix of end industries and products, and being able to reach all customers and having access to all regions, which increases our flexibility and allowed us to sort of offset the declines in certain markets and for certain products, and through growing in other markets. Of course, cost control, it's one of the most important things at the current moment, especially given the shifting market demands. You need to be flexible in order to cope with that, and we at JOST managed to do it quite well. And the aftermarket business also supported tremendously, especially in the North American market, where demand for first fit, OEM demand, as we call it, it's actually declining sharply. So if we look into the regions, and here we get to see that it wasn't not the growth was also organic in all regions as well. In EMEA, so Europe, Middle East, and Africa, we grew by 40% to 182 million euros, including the Hyva contribution. Organically, the growth was almost 13% year on year. And we managed to also improve here the margin to 6.3%, bearing in mind that Europe, of course, has the headquarter costs attributed to it, and it's the reason why its margin is always a bit lower than the other regions. But here we saw the first synergies effects taking place. The adjusted EBIT grew by 57% compared to prior year. In the Americas region, we increased our sales by 38%. Also, a very strong Hyva contribution, but organically, and that's something we're particularly proud of, even the strong headwinds coming from the North American market, we grew by 6%. This had to do with a very good aftermarket, certain growth, new market shares, and especially in the South American region, where we are now entering the market more strongly with our agricultural business and construction business. So that actually did quite well. And from the earnings side, we grew adjusted EBIT 11%, and the adjusted EBIT margin was already at 10.3% despite the dilution from Hyva. Also here showing the energies starting to kick in. And of course, APAC is the region with the strongest growth that we had, because it's also the region where Hyva is the strongest, especially in India and China. There we saw a growth of 137% compared to prior year quarter, organically 6.6%. Especially the growth came strongly also for just the Chinese market and the agricultural market, India as well as in China. Adjusted EBIT went up by almost 80% to 40 million, with adjusted EBIT margin reaching 14.7%. And you see here, maybe something to note is that from a profitability point of view, we have a fairly even distribution of adjusted EBIT across all three regions, which gives us a lot of flexibility when it comes to maintaining the high profitability at JOST and dealing with the current market environment. So overall, regarding our outlook, given the performance we've had so far in the year, we have confirmed our outlook for the year 2025. And still expect sales to grow by 40 to 50%, and adjusted EBIT and adjusted EBITDA to grow by 23 to 28% compared to prior year. Of course, very strongly supported by the incorporation of the Hyva company, but also through organic growth. Thank you very much for your attention. If you want to learn more about JOST and what we're doing and what we want to achieve in the future, please feel welcome to reach out to me or to check our webpage. Thank you.
Thank you, Romy, for sharing these insightful updates on JOST Werke's performance and strategic progress. For investors who want to learn more, visit Seat 11A to explore additional videos, including the elevator pitch, financial results, and deep dive presentations, offering a comprehensive view of JOST Werke's business and long-term growth potential.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.